Welcome to our inaugural presentation for Future Energy Thought Leadership Series. So today we've got a presentation on the Global Carbon Reward Initiative with our guest Dr. Delton Chen here today to talk to us about the initiative and the work that they've been doing over the past, how many years?
6 years.
6 years now. So this series is part of a broader thought leadership series that we're putting together from ourselves and the Future Energy and Energy Transition team. Can you just go to the next slide for me? And I guess it's part of our broader Creating a Better Tomorrow from Wood perspective, and really this program is here to promote thought leadership and critical questioning. We're looking over the period of these presentations, which we're looking to hold around 6 weekly intervals. We're looking to engage with innovators in varied fields in the energy, interacting in the energy space. And we're really providing an opportunity for those people to present and discuss some out-of-the-box and left-field ideas. We really put this program together with a recognition that as technical professionals, we often have opportunities to work through and discuss items and elements that are quite directly related to our space and our energy sector. And the intention here is that we will be allowing the opportunity for us to look at concepts that are quite left field and varied, with the intention of unearthing some new ideas and some conversations. So today, as I said, we've got a presentation from Delton Chen, and he has been working over the past few years on the Global Carbon Reward Program. And I think today's discussion is particularly pertinent in the conditions and the market conditions at which we are faced with. We have pandemic conditions, we have economic and market uncertainty, and governments obviously printing money and accumulating debt at a record rate. Overlaid on top of that is a strong desire globally in the private and public sector to drive towards a net zero outcome for carbon. So I guess it's with that in mind that today's presentation from Delton, I came across this concept probably 6 months ago, and today I guess what we're going to hear about is putting a 180-degree spin on a move to net zero, and we're actually looking at promoting low emissions to zero emissions behaviour rather than it being a penalty. So it's with great pleasure that we introduce Delton for the presentation today. Thanks, Delton. Over to you.
Thank you, Steve.
Thank you.
Can we have the slide? Yeah. I think it's great. Well, thank you for inviting me to speak today, Steve and Tim. It's really a great pleasure to be here. As we just noted, the Global Carbon Reward Initiative has been in ideation stage for 6 years, and we're officially launching on the 5th of June on World Environment Day. To set the context for this presentation, I'd just like to reiterate what ARENA has been saying about investment in renewable energy. They report that we need an additional about $0.8 trillion per year from now until mid-century to approach the goals of the Paris Agreement. That shortfall is roughly 50%. In terms of all energy infrastructure investment, the IEA estimates that we need about $5 trillion per year investment in infrastructure by the end of this decade, and that's to have a chance of meeting the net zero goal by mid-century. And that's probably because of lock-in of infrastructure. Then the OECD reports or estimates that we probably need about $6.9 trillion per year invested in new infrastructure by 2030 in order to have a chance of achieving the Sustainable Development Goals and the Paris Agreement. So that's quite a lot of money, a lot of additional investment. The Global Carbon Reward is designed to address this investment shortfall. So it's a policy that will offer debt-free financial rewards for mitigated carbon and with weightings for co-benefits. So this policy has 2 key objectives. The first objective is to set a limit on global warming by managing the anthropogenic carbon balance with financial rewards. The second objective is to attempt to maximise the co-benefits for communities and ecosystems with reward weightings. So this is fairly objective, and this is subjective. To understand the policy in simple terms, we have three major reward rules for funding and incentivising climate mitigation. So the first is a reward rule for cleaner energy, which would be interested in. The second rule is for cleaner business, and the third rule is for carbon removal. So the first two rules are about conventional mitigation. The third is unconventional, but this third rule is needed because analysts say that we're going to experience about 800, 900 gigatons of carbon dioxide above the budget for 1.5 degrees. So if we want to stay below 1.5 degrees, it's pretty much locked in that we're going to need carbon dioxide removal on a large scale. So how does it work? In simple terms, the policy, well, the carbon removal policy, actually uses carbon currency as the instrument. So I'll explain how it works. Just imagine we have many projects providing cleaner energy, cleaner businesses, and carbon removal. So these projects, if they qualify, can approach the Carbon Exchange Authority, which is a new authority, doesn't exist currently, and request a service level agreement. If they qualify, they'll be given an agreement, and this will contain all the details that conditions they'll have to meet to earn the reward. It'll cover everything, like how often they have to be assessed, measurement report verification. It'll say things like you can't double count carbon offsetting, things like that. Then they will be assigned a private mitigation assessor, a contracted person, who will then do the analysis and evaluate how much carbon they've mitigated. And finally, if they pass those hoops, they can be rewarded the digital currency, our carbon currency. And it's kind of that simple. Of course, the devil's in the details, but in this presentation, I'm going to focus on these three key questions because these are the obvious questions. How do we fund such a policy that's providing trillions of dollars? What's under the hood of the policy, as in what's the theory and the principles, and then how do we calculate rewards? Question one, how do we fund the policy? Okay, we're going to use central banks. So the central banks are important to this policy, they're fundamental, and we need to take note of their mandates. So they have mandates already. The three major areas of their mandates are monetary policy, where they set interest rates. They have a mandate of market neutrality, which means they create a level playing field for market participants. And then they're concerned about systemic risks like financial stability. So, of course, we're familiar with financial instability now from the global financial crisis and the COVID recession. Central banks are concerned about the climate as well because they know that there will be climate-related financial risks. And they classify them as three types. Physical risk, which refers to financial losses and damages. Transitional risk, because there can be stranded assets and investments. And liability risk, such things as litigation and insurance claims. So these kinds of risks can contribute to global financial instability. But what more should they do? People are asking, can central banks help with the climate crisis? Under this policy, we claim that they should be given new mandates, specifically to provide climate mitigation finance. Now, the point here that I'd like to emphasise is that their existing mandates focus on the downstream problems. And I claim under this policy that they should be providing climate finance to tackle the problem upstream. This approach, we give it a name, we call it preventative climate insurance. And we need a new institution called the Carbon Exchange Authority. It doesn't exist currently. So what is quantitative easing? This is relevant. In very simple terms, quantitative easing is when a central bank buys assets to put more money into the economy to stimulate the economy, particularly when interest rates are already low. So a central bank has a balance sheet and with assets and liabilities. So in this example, we'll just start with 0, 0. Okay. So they create some money digitally from nothing. Let's say they make $1 billion. It'll register as an asset and a liability, and then they'll use that money to buy a bond. Let's say they buy a government bond worth $1 billion. So that's how it works in the simplest terms. They have an asset and a liability that's matching. And so on and so forth, they can buy other bonds and other financial securities. So in this example, they've bought $3 billion worth of bonds and they've got $3 billion worth of currency as a liability in the system. Okay, now what about green quantitative easing? So there have been proposals that central banks should buy green bonds, climate bonds, to help solve the climate crisis. Now, the central banks, from what I've heard, they're not too keen on this. One reason is that they see the climate bonds as being too granular, too technically complicated, because they have to investigate the details. So they don't really like the idea. Also, it's not market neutral, which is one of their mandates. And finally, analysts suggest that if they did buy lots of bonds, climate bonds, it wouldn't necessarily make a big difference to the climate for some reasons to do with the correlation between the bonds and the carbon. So we have a different approach under this policy called carbon quantitative easing. And it is fundamentally different because we recommend a new institution called a Carbon Exchange Authority, which will have its own balance sheet. So it will start with zero assets and liabilities, and it will invite projects to provide services, so cleaner energy, cleaner business, carbon removal. As I already explained, they will sign on to a service level agreement. Once that agreement is made, it forms an asset on the balance sheet of the authority. So that's now an asset, and then the authority can then print the digital currency, which is our carbon currency. And it has the units of 1 unit carbon currency is equivalent to 1 tonne equivalent mitigated carbon, mitigated for 100 years. So that's the unit of account, and that's how we do the accounting. And the asset then is given to the projects, which has value. So the next question would be, how do we give value to the currency, or how does the project realise the value? Well, what will happen is that the project has our carbon currency as an incentive and reward, and they will want to, at some point, spend that money. So they might need to pay wages or pay down debt or whatever. And generally, they can't use the carbon currency to do that because it doesn't have legal tender status. It's like foreign currency everywhere, and it's not a carbon offset credit. So what they're going to do is sell some of it into the market, and private investors and currency traders will buy it. Now, why will they buy it? Well, the reason they'll buy it is because this currency is managed. Okay, it'll be managed by central banks so that its exchange rate is rising over the long term. And because it's rising in value, it is effectively an investment. It's an investment grade currency. So private traders will buy the currency because they know it has a yield, and that yield can be quite significant based on the need to mitigate. Because this, I'll just explain this very quickly, this chart actually is the exchange rate for our currency in the quote for US dollars. So when you present a chart of the exchange rate with the carbon currency as the base currency and US dollars as the quote, you've effectively got the reward price because it's got the right units. So it's very convenient. The exchange rate actually is the reward price. So that explains the incentive. And so here an exchange is made between hard currencies and our carbon currency. And then if some reason there's not enough demand for the carbon currency in the marketplace, say the price is dipping below the floor price, the central banks will come in under their mandate to buy. So they can use their reserve currencies or print more money and buy the carbon currency, and that will raise the exchange rate. So that's how it works. There are some advantages for central banks with this approach. For one, they don't have to do any technical analysis of the projects, because that's all taken care of by our new authority. And for the world, the advantage is the cost of these many trillions of dollars for climate mitigation will be dispersed around the world economy as mild or thin inflation by printing more money. And the amount of currency each central bank will print will be determined by the authorities, so that the inflation is spread and becomes benign as possible. So that's the funding mechanism. And now I'll just answer the question for us, what's under the hood? So by what's under the hood, I'm referring to the question of, is this policy ideological, or does it have some kind of scientific basis and some principles to it? This is an important question, particularly for economists and philosophers. To answer this question, I think it's useful to reflect upon what most people say about the climate crisis. So the climate crisis, by some people, is considered to be a problem that we already understand. We have facts, we have the solutions, so just fix the problem. And I think what Greta Thunberg is saying is that we just need to get the politicians to do something with policy. What I claim is that that's not correct. I think we don't have all the facts and solutions because there are major unresolved economic issues. So here's a sample of some major ones, and I'll go through them very quickly. The first problem is economic growth. Some people say we need green growth or a circular economy, but we've never experienced green growth. And a circular economy is just too simplistic to manage the world economy. Other people say we need degrowth, but there's no clear definition of what that is, and it's hugely unpopular. Carbon taxes. Some economists say carbon taxes are the most efficient, best policy. Other economists say no, cap and trade is better, and other people say it doesn't matter, carbon taxes, etc., too unpopular. Time discounting by economists. Some economists prefer 2 to 4% discount rate. Other economists say no, it should be lower, but it's impossible to find an agreement because it's subjective anyway. Energy efficiency. We need energy efficiency to reduce emissions, that's true, but in the long term, it might not solve our problem because of energy rebound effects called Jevons paradox. Some people say we can achieve 100% renewables by mid-century. Some people say it's plausible for many nations. Other people say no, it's not plausible at the global level, for physical reasons. Some people say fossil fuels will remain a major source of energy throughout the whole century. So the next one, carbon dioxide removal. Some people say we need it on a large scale. I tend to agree. Other people say it's unproven at scale. It will encourage more pollution. Forests and soils leak carbon, and actually that's true. Tropical forests are leaking carbon, the Arctic region is leaking carbon. Solar radiation management, that's very controversial. Some people say it's needed, it's climate scientists. To limit global warming and reduce climate feedbacks, they're probably right. Other people say no, we don't want it because it's not natural. It's too risky. Some people say it will encourage more pollution. Carbon offsetting. Many people say carbon offsetting is needed because it supports low carbon projects, which it can do. Then other people say, look, the emissions are not actually reducing at the source, and it introduces new risks, which it does. So here are, I think there's 8 examples of major questions which really are unresolved. So the resolution that I put forward with the Global Carbon Reward is to reanalyse market policies. So this slide is trying to communicate that there's a climate policy landscape, many different policies to consider. We have, for example, many different command and control policies like regulations from government. We have global governance, for example, the Paris Climate Agreement. And there are geoengineering options, interventions like putting soft dioxide in the atmosphere or something like that. But if we focus on market policies, we have carbon subsidies, well known, 45Q in the United States as an example, carbon taxes, everyone's heard of that, cap and trade, European ETS, you're familiar with that, carbon offset markets, voluntary and compliance, everybody's heard of that, and there are variants of these policies like fee and dividend, etc. So what I put forward here as a new idea is that we should be looking at these market policies in what's called the carbon pricing matrix. And this matrix is a relational diagram that compares the major policies in a particular way. And it's a 2x2 matrix that I'll explain how the matrix works really quickly. And if you find it interesting, I recommend you go to the website because there's some YouTube videos and a better explanation. But what the matrix is really a diagram that divides policies according to whether they're sticks or carrots. Sticks have a negative store of value and carrots a positive store of value. The columns denote two types of unit of account. So the way the policies are organised, they can be organised around fiat currency, which is the national money, or carbon units. So for example, cap and trade, it's a stick, and it uses emissions permits to trade to realise the price for carbon. And so that's the basic background to the carbon pricing matrix. There's a lot more to it than just that, but what it highlights is that we're missing a policy in the matrix. And what I claim is that that missing policy is actually our carbon reward, or our global carbon reward. And so through the analysis, what I propose is that we should actually be working with two major prices for carbon, effectively sticks and carrots, or carrots and sticks. So the stick refers to our carbon tax, and the ideal tax is defined as a social cost of carbon. And then our reward is the blue line, and the ideal reward is called the risk cost of carbon. So this is a formalisation of market pricing. The matrix doesn't exist in textbooks. Leading economists don't discuss it because it's very new. But it opens up a new vista of understanding about market pricing and carbon pricing. So one of the insights from the matrix, which is hasn't really been proven, but I believe it can be proven eventually, is that these policies have particular relationships to costs and risks, which are inherent. So what I claim is that the carbon tax is ideally suited to managing the efficiency of markets based on the analysis called cost versus benefit analysis, which is the conventional way economists analyse social cost of carbon to define the tax. And what I'm saying is that this matrix associates or reveals that the reward is ideally suited for managing risk, and therefore it's ideally suited for managing probabilities. So it's a pattern that emerges where we use the carrot, the reward, to price risk using risk assessments. We use the tax to price costs based on cost-benefit analysis. The other two policies are kind of hybridized, so they're a combination of these two functions. Now, for some of us this might all seem a bit very theoretical, but for economists this is quite revolutionary. Behind it are some social principles as well. So the carbon tax is supported by this notion of the polluter pays principle, and here we present a new social principle that will justify the reward, and it's called the preventative insurance principle. And effectively this is saying that society deserves to have the climate problem prevented through the notion of insurance based on this reward. Now, I'm going to go through this quite quickly. This is a bit more background as to the theory under the hood. Some of the insights or the interpretations that are that we need the new social principle, preventative insurance principle. There are experiments already that show that human cooperation actually maximises with carrot and stick incentives. So this is important social science understanding. And then finally, a biophysical model was developed to support the analysis. And this model or analysis takes into account energy conservation and entropy changes as laws of thermodynamics. And it arrives at a closed-loop control system model for the world's carbon emissions. So that's quite a different way of looking at the world economy as a system. And it introduces the notion of optimal growth, which requires a trade-off. Optimal growth is a trade-off between efficiency and safety. That's explained on the website. And it may be possible to validate this against carbon-neutral biological systems. Also, the analysis highlights why information sharing is so important. This analysis will be presented in the future around June, July. If anybody is interested, just contact me, because we are looking for sponsors and support to present this material. And so I'm coming to the third part of the presentation, and I'm actually a bit ahead of myself. I'm going faster than I thought. Maybe I'll slow down a bit. How do we calculate rewards? So I will slow down. The third question. On the website, we actually have a hypothetical storyline to explain this. And I chose the green hydrogen transition as the storyline, not because I'm favouring hydrogen, it just makes a really convenient story because it's got grey hydrogen, blue hydrogen, green hydrogen. This is actually a design of a new design of a ship that would be powered by hydrogen, and there are people in Europe designing and building these things. So how do we calculate the reward? Well, the first step for any energy project, I'm only talking about cleaner energy now, is that we need to calculate the notional mass of carbon mitigated by the energy project. And I just want to say to the Wood staff, if you have any ideas or feedback on the calculations, I'd love to hear from you, because we need feedback to evaluate the feasibility of the policy. So the first step is to calculate the notional mass of carbon mitigated. And the way we do it, the way we recommend, is that we focus on reductions in the carbon intensity of the energy commodity. So there are lots of different commodities, but each commodity would have its own characteristic carbon intensity, carbon per megajoule of energy. To do that, you need a baseline carbon intensity, which is prescribed under the policy, and then we measure the carbon intensity of the energy commodity. And the difference is the reduction, and then we multiply that by the amount of energy supplied to calculate our notional mass. So hopefully that's pretty clear. It is a fairly straightforward calculation. Each energy commodity will be prescribed a unique carbon intensity baseline. So here is a graphical example. Hopefully this will clarify it even further. It's a hypothetical. So let's imagine we're in the year 2025 and we're thinking about a certain energy commodity. That company that's producing the energy could have a forward plan of decarbonising. Let's say they have grey hydrogen and they're thinking about producing a lot of green hydrogen. So they could decarbonise into the future, and that's what they're planning for. If the Carbon Exchange Authority sets this baseline, then they can calculate the change in carbon intensity of their energy supply. And from that they can calculate or guesstimate the notional mass. Now, the way the policy could work is that we could have a guarantee period of carbon intensity, and it might go out for, say, 10 or so years. And the reason would be we'd want to give the marketplace confidence that they can plan their projects and then estimate how much revenue they'll earn from the carbon currency. And from that, they can then go to the debt market, borrow money, or raise equity, etc., and take those risks of investing in these new technologies. Now, the Carbon Exchange Authority, when it prescribes the baseline, it can place the baseline anywhere. It doesn't have to be high, it could be lower, or it could be even lower still. And what I'm trying to explain here is that this baseline is not like a business as usual baseline. We don't need to be stuck in that mentality. We will use the baseline to prescribe any kind of financial outcome, and the authority will optimize it to create a price signal that's not too high or too low, because we want to get a kind of optimum price signal that's sufficient to encourage the energy producers to actually do the transition on time. That makes some sense. So this is the example going out to the year 2110, and it's only hypothetical. Now, once we have calculated our notional mass of carbon, we can then multiply it by the reward price to evaluate the base reward. In this example, the reward price, remember it's a carbon currency, CC. When currency traders talk about exchange rates, they present the base currency and the quote currency. So in this example, the quote is in US dollars, and as I said before, the exchange rate has the units that we need. The units for this are actually US dollars per tonne of CO2 mitigated for 100 years. So we just multiply that by our notional mass, and then we have the reward in US dollars, and that's the base reward. So what I'm going to explain now is that we will look at the reward going out to the future. So under the Global Carbon Reward Policy, the authority will advertise the reward. So they will present charts like this to the world. Let's imagine we're in the year 2025. So you go to the front page of the newspaper, or maybe it's the back page, I don't know. But you go to the newspaper and you'll see this chart, and it says that the Carbon Exchange Authority is planning to manage the exchange rate just as it's shown. Starting low at the beginning of the policy, rising up to maybe $200 or $300. What the actual value is, I don't know, because we haven't done assessments, but this is hypothetical. So if you're the energy company and investor, you're looking at this, and then you can calculate roughly how much carbon currency you can earn based on your cleaner energy supply. And intentionally, the Carbon Exchange Authority will guarantee the floor price for some years into the future. So in this example, it's 20 years. And the reason being that if there's projects with high capex, building lots of infrastructure, the investors and the companies need to have some certainty that they'll have that revenue stream. And that's why it's guaranteed for this period of time. And then beyond that, we have a period called forward guidance, where the authority kind of guesstimates what it will likely be for the rest of the century, with some confidence limits. So that's the global reward price. And imagine now that we're in the year 2045, so 20 years later, we look back, we can see that there was a historical price for the carbon currency, and you notice it's higher than the floor price, which makes some sense, because when private actors are trading in carbon currency, the price can rise in like a bull market and can fall, just like a lot of things do in financial markets. But it will never fall below the floor price. And the floor price in the future is rolling outwards, and this is rolling outwards. So then, in the year 2065, this is hypothetical, of course, we notice that the exchange rate for our carbon currency is starting to plateau, and that would indicate that the world is coming close to actually getting the climate problem under control. The fact that the price might peak and then begin to fall is a good sign, because that would indicate that the risks are being managed. If, on the other hand, maybe there's climate feedbacks that weren't expected, the price could just keep rising. And if the price kept rising and went exponential vertically, that's a complete disaster, because that's a runaway climate event. So that's how it works. Into the year 2100, we can then see that there was a successful outcome, and then the price will probably fall and plateau somewhere, because there will be residual carbon emissions and a need to draw down carbon out of the atmosphere. So that's the reward. I've explained the notional carbon, mitigated carbon mass, the base reward, and now we're moving into the last part of the analysis, because here we're interested in governance. So if the world is going to decarbonise civilization in every country, that's a lot of projects, and that's a lot of wind turbines and solar plants, etc. And there will be a lot of impacts on communities and environments, potentially, tens of thousands of projects. So to help manage the governance of this, we introduced this notion of weighting factors for co-benefits. And the idea is quite simple, really, in that we have our base reward, but we're going to multiply it or adjust it for the co-benefits. If there are positive outcomes for society and ecosystems, we weight it up higher, and if there are less or there are harms, we weight it down lower. And that's why we end up with our weighted reward from the base reward. And so, from a mathematical point of view, this graph here, which is like a histogram or frequency chart of the weighting factors, you notice it's likely, it's normally distributed around 1. And the reason is that when projects produce more co-benefits and we weight up their rewards, those rewards or additional rewards are taken away from the other projects that aren't so good for society and environment. So we take from Mary and give to Paul. Because we take from Mary and give to Paul, there is no artificial creation of carbon currency. It's a net zero change. And that's why the mean of the weighting factors should be close to 1. Now, I'll just explain a bit more clearly that the weighting factors are actually supposed to take into account 3 types of co-benefit. The first is energy reliability. So this is about gauging whether projects are causing the energy network to become reliable or whether they're adding reliability. The second is community well-being, and then the third, ecosystem health. So I'm coming close to the end of the presentation, and in this last part, I'm going to talk about the stakeholder groups for adjusting rewards. Now, what this is about is finding a way for society to influence the weighting factors. In fact, stakeholder groups will be the groups that actually, in a sense, determine the weighting factors. So for energy reliability, what will happen is, for each energy commodity, experts in that commodity, let's say it's green hydrogen or green methane or renewable energy, electricity, or any kind of clean energy system, the people who are interested in that technology can volunteer themselves to be in the stakeholder group. So that will be consultants, consumer associations, people who are interested in health and safety. Could be, like, for example, the steel industry that would be using green hydrogen. They would want to be in that stakeholder group. So the stakeholder group forms organically, and they vote in a kind of online system to define the criteria for judging the co-benefits. That's an expert group. Over here, ecosystems, it's a bit similar. So for ecosystems, what we recommend is that the stakeholder group be comprised of ecologists and biologists and protectors who are interested in protecting ecosystems in their region. So these two groups wouldn't be open just to anyone, they're kind of expert groups. But the middle one for communities, that's open to everybody. So everyone's a citizen, and these groups will form to influence the weightings for those projects that affect their community. So that's in a nutshell. I haven't really explained how it works because it would take too long. But assuming that would work, then we only have one more step to finish the calculation of rewards. And the last step is where we charge an administrative fee from the weighted reward, and this fee is to cover the cost of all the administration. So the whole global carbon reward system is like an ecosystem, like its own economy, because it can fund itself by charging fees in the carbon currency. And therefore we get the net reward, which is the final payment to the project owners, whether it's clean energy or carbon removal or cleaner business. So I'm coming to the end now. Demonstration projects. Obviously our group can't really implement the policy. We don't really have an intention of trying to do that. Our intention is to showcase the policy with demonstrations. So we would be looking to find a national government and the help of their central banks. So we don't really need to create new legislation for demonstration projects. We just bring in the central bank to do the currency trading, and we raise the money externally from government and private sector to pool in to back our carbon currency for the demonstration. So to conclude, how can Wood support the Global Carbon Reward Initiative? Well, if you'd like to help us, please connect us with corporations, governments and NGOs. If you really like the policy, you're more than welcome to start your own GCR working group in your office. You could also help us raise money. We would need roughly $250,000 to organise the demonstration projects. And then if you really like the policy, you're more than welcome to donate. It's tax deductible in the US. So thank you very much. I'd like to thank everybody for taking the time to be here and to listen to my presentation.
Thanks very much, Del. So we've got a couple of questions for you, and then we'll go to the floor. So a few people have written in some questions online. So Vishwanath has asked, what portion of the budget is planned to be set aside for carbon capture projects, and how do we plan to implement these in the APAC regions where 90% of the energy demands are met through fossil fuels?
Okay, that's carbon removal, this question. How much do we allocate to carbon removal? The whole policy is market-based. So we put the price signal out to carbon, and it's up to projects to do the carbon removal on the price point. So we don't really specify how much is to be pulled out of the atmosphere, because we just set the price point knowing that that price point is likely to achieve a certain result. So it's kind of average. There is no direct allocation of money specifically to carbon dioxide removal, but the Carbon Exchange Authority will have analysts who are doing a lot of calculations, and they will have a feeling for what will happen. So if there is not enough carbon dioxide removal and they feel there should be more, they can create more opportunities by providing more administrative support for different types of carbon dioxide removal. So you can sort of choke it off by reducing the kinds of technologies that will be rewarded, or you can open it up by offering it to a wider variety of carbon dioxide removal. So that's how you can regulate it to a degree.
As that would cover the second part of the question was around the question in APAC where 90% of our energy demands are met through fossil fuels. That's sort of the same tool to manipulate the...
Well, for those regions that depend heavily on fossil fuels, this could be a real boon because it just means there's more opportunity to earn rewards by producing cleaner energy.
Okay, perfect. There's a second part to that question as well, which is a bit of a theme that's come through, which is an interesting question. Carbon currency seems similar to a digital asset, i.e. cryptocurrency, which already has a large carbon footprint. And then the quote is that Bitcoin mining contributes 0.55% of the global energy footprint, which I think we all know. And the question was, how do we sidestep this paradox?
Yes, it's not really a problem because the currency will be centrally managed. It can still use blockchains, but we don't have to rely on hashing like Bitcoin.
Or proof of work.
No, don't need proof of work. There's other technologies out there that don't have this hashing requirement, like Hedera Hashgraph. Anyway, gross settlement systems don't do all this hashing. It could be on a conventional gross settlement system with centralised ledger.
So we're saying really, I think there, that it can use the benefits of a distributed ledger without the requirement of the energy-intensive background hashing that a Bitcoin requires.
Yeah, that's what I would say.
Perfect. And another question here is, there's a question here around the recent announcement of the International Energy Agency, warning yesterday, I think the headline was, that we need to curb fossil fuel demand by mid-century 2050 and no further investment in fossil fuels. How will this carbon currency work in the future?
Well, in response to that statement, that's it's not a law. The IEA can't tell anybody what to do, really. It's up to governments to impose those kinds of restrictions, which are quite command and control and harsh. So there may be a role for that kind of command and control regulation, but the problem is we still need the energy companies to produce the energy. So either we tax them, penalise them, in which case there'll be all sorts of problems, or we offer them carrots and sticks. So with carrots and sticks, it'll overcome the need for centralised command and control, and it will allow the energy companies and the innovators to start finding solutions. And I think if you don't provide the finance, it doesn't matter how strongly you tell them to decarbonise, they won't necessarily be able to do it, because I think they still have to balance their accounts. They've got to stay in the black and remain profitable, pay their bills and their wages and everything else. So without getting too intellectual about this, I think carrots and sticks is probably the best way to go to get the desired result. It may be the optimal. Other people might disagree, but keep in mind, the reward is not saying we don't need taxes or regulations. It's saying if you begin with carrots and then when that's getting things moving, you can follow with stronger sticks. And society's not going to resist it because everyone's sort of moving in the right direction anyway.
Common incentives.
Yeah.
So another question here I think is a relevant one is there was a comment, obviously the coin and the currency is based on mitigation of tonnes per 100 years. The question is why 100 years? And then there's a follow-on question is, will the actual asset last 100 years?
They're really good questions. The first part is from a science basis, when carbon greenhouse gases go in the atmosphere, most of their impact occurs over roughly 60 to 80 years, CO2. So the way I explain the 100-year duration, we're interested in keeping carbon out of the atmosphere for that 100 years, because we have to settle on a certain time, whatever it is, 60 years, 80 years, 100 years. So it's kind of like driving a car, as a metaphor. You're driving a car at night, the metaphor is your headlights give you a certain distance of prior warning to something going wrong in front of you. So an animal jumps out the road, you've got a certain time to react. So in the policy, metaphorically, that visual distance of your headlights is analogous to the 100 years. So we have a, sort of like a 100-year forewarning about what's coming up ahead. And it takes time for society to respond with infrastructure, new technologies, and hence everything has got this 100-year planning horizon. It could be adjusted downwards to 80 or 60 years, but I think 100 years seems to feel right.
And how does that fit with the asset that underlies that removal? Is there a requirement for the asset itself to operate for 100 years?
Well, the asset, the carbon currency, in theory, it can circulate forever. It could last for infinity of time. It wouldn't really be a problem. However, there may be an argument for cancelling out the carbon currency after 100 years. That would be like a demurrage fee. And that's an option, but I'm not sure if it's necessary. It just depends on how important the carbon currency is to society in 100 years' time. If people, if there's a lot of demand for it, you wouldn't have to cancel out the currency, it'd kill it. But most currencies do die at some point. For example, our money can disappear. Commercial banks do that all the time. When they take the loan back, it cancels out on the ledger. So after 100 years, the answer is it could be cancelled out, but should it be? I'm not sure.
Okay, that's good. So, look, in the interest of time, just to allow if there are any people online who, if there's anyone who wants to ask a particular question, we will though be allowing opportunity for Q&As, and we'll have a mechanism for people to ask, and we'll allow that, you know, discussions with Delta after. But is there anyone online who has any question? We probably have time for one question if anyone has anything.
Does anyone in the room have a question?
Of course, do you want them now or for the next half hour?
No, just one. You've got
Just
one
one.
question.
All right, I have a question around the central banks. And given that this is a global issue, to what degree do you need to have a consensus or a number of central banks joining in? And then if you don't, how would you manage that scenario? What would that look like?
Yeah.
My second question was actually around you talked about managing the currency, but then what you showed was something that looked like it had a free market flair to it in reality, so I was struggling to reconcile the two of those things.
Okay, so ideally all the world's central banks would be part of the policy, but in reality we probably wouldn't expect that necessarily. So in the minimum, we would really need the G20, because that represents most of the world economy. That's where the economic wealth is. If, for example, the G20 supported it, that would probably be enough to fund the whole policy. And developing countries would probably like that, because they don't necessarily feel they're responsible for all this climate problem, because they're not really historically responsible for it. So the short answer to your question is, it really does depend on countries agreeing to it, the big economies. And the reason they might is because if we don't do something on a global scale, we could end up in hot water. So there is a self-preservation motivation. The other reason they might join could be based on the science basis and the economics. So the other question was?
So the other question was more, you talked about how the currency would be managed upwards.
Yeah.
The graph you showed
It fluctuates.
fluctuated, which implied there was a free market effect to it. So I was trying to reconcile managing with free market effects, which seems a little interesting.
Well, there are two ways. Somebody did tell me that another option is just to purely fix it. So it's an exact exchange rate that's tightly controlled. I'd love to hear from economists on the pros and cons, but intuitively I think it's better to let it float because it's more natural. It has another benefit, and that is if society wants to mitigate even stronger than what the policy proposes, everyone in the world is invited to buy the currency, and that will increase the exchange rate and will hasten and intensify the mitigation effort. So it provides a kind of decentralised governance. That's one benefit, and that's really the answer. It's floating, but if it drops, the central banks will buy it. That's my answer.
Thank you. That's great. Thanks very much. Thanks, Delton. And look, as a token of our appreciation for the for your presentation today.
Yes. Wayne?
Thank you very much, fantastic. And look, thanks to everyone as well for dialing in, and look, many thanks to Delton as well for the work he put in to present. We will be providing the Q&As separately to this, so any questions that we didn't get covered today, we will make sure that we get feedback from Delton and the team as well. There'll also be some information on the new website, and we'll certainly be following Delton's work with interest. So we hope to have our next presentation in around 6 weeks, I think. And at this stage, we're hoping for a presentation on the fusion reactor in France. So we're working on putting together a presentation, some background around the technology for all of us that may be interested in fusion technology. So thanks very much everyone for today, and we look forward to presenting in 6 weeks' time. Thank you.
Thanks very much.
Thanks, Steve. Thanks, Tim.